Hi, I'm Sameer Jain at Active Allocator. The theme for this talk is control-oriented investments in capital and distressed companies, capital-constrained and distressed companies in the lower middle market. So many years ago, I had written a paper at a Wall Street bank investing in distressed debt, which got picked up by CAIA, and many folks still cut and paste from it. So I was recently asked, hey, what opportunities from a hypothetical credit market fallouts do you see? So I tried to think and here are my thoughts. I feel that control-oriented investments in distressed and capital-constrained companies in the lower middle market will be a big area. The lower middle market still remains very underserved by distressed investors, and there are many reasons for this, but what stands out this time around is illiquidity and a lack of public information. It continues to create inefficiency, which seems to be deterring trading-oriented investors. Also, traditional distressed funds in 2018 have migrated to larger and larger transactions, and substantial investment opportunities will continue to rise as default rates, which are low if they rise. So there will be opportunities to purchase distressed debt or inject new capital with the intent of creating a controlling or influential equity position. And these opportunities will be in areas such as to purchase fulcrum distressed debt securities that are likely to be converted into equity, bank debt, mezzanine, high yield debt, maybe rescue financing, structured financing for companies that are capital constrained, broken options, divestitures. So investments in distressed securities and assets are, as we know, they're frequently undervalued by the market. This provides the prospect of greater appreciation than securities and assets of more financially stable companies. So, of course, although interest rates are rising in the near future, default rates on high yield debt do continue to remain at near record lows. But I think this combination of factors has caused opportunities to emanate in the secondary market, and public and privately traded distressed debt to be relatively limited as yet. And the other thing that you see if you read the Wall Street Journal is the larger amounts of issuance coupled with what is believed to be a less rigorous underwriting criteria once again will inevitably create more opportunities in distressed public and privately traded bonds and debt when the economy softens, if it does so. So this will present opportunities to invest in weak operating companies where returns can be generated through the stabilization of operations. So there's an opportunity for purchasing secondary debt too. And the supply of this debt remains available, though it is, what I hear, somewhat diminished in the current environment, as banks and other traditional lending sources may sell their loans when borrowers develop problems. Then this other opportunity in private equity or subordinated debt in companies with liquidity needs, that's out there. Later there'll be bankruptcy sales and corporate divestitures to benefit from any increase in the supply of middle market or larger investment opportunities that may come to be presented by an economic downturn. Remember, this is all hypothetical, so the rise in corporate bankruptcies that may occur and the pressure that may be felt by companies that are not in bankruptcy to rid themselves of non-core assets, this too may result in an increase in private equity opportunities for investing in bankruptcy sales, corporate divestitures. So while traditional buyout investment funds do have operations team, they typically hesitate to make investments in companies that require substantial turnaround, including things like reorganizations, etc. So funds that are able to take into account things like reorganization, subject to the complicated regulations that are there in the bankruptcy process, that involve numerous constituencies that have to be satisfied. So if one peels the onion, this space is going to be replete with opportunity in the event of an economic downturn, and I'm sure these opportunities already exist, but one needs to be in the deal flow. I'm not in deal flow, but I just thought I would sort of opine on a space that I was pretty close to a few years ago. Thank you so much for listening in. Bye bye.